It's a pleasure to be here today, and I think CEDA should be congratulated for producing a report at what has become actually, although I think at the time it was written perhaps not so well known, but a very dynamic context when Australian politics on this issue is changing by the hour. And so I think in that sense, CEDA's report comes at a time of great policy uncertainty in Australia, a point I'll come back to. And I think what CEDA's trying to do in this report is to again draw out that climate change is not just an issue about politics, but there are more serious economic and very serious investment issues here which have to be considered in the climate debate. So the chapter which I've written in the report, which is the first chapter, is really focusing on the economics of climate change, and in particular, I think the thesis is that regardless of what we do in Australia, we need to look beyond what's happening here and the domestic political bout to see that the entire world is moving in a different direction, particularly in terms of regulation and also in terms of the investment patterns that are happening around climate change that we just simply can't ignore. And to simply sit in Australia and say we shouldn't have regulation on climate simply ignores what's going on in the broader community. For many Australian companies that operate in this global sphere as well, but it's also very important that they are cognizant of what's going on elsewhere and the climate exposure they have, and it simply cannot be ignored. So for this room, I think many of the points perhaps that I argue in the paper may not be that different, but I think what may be surprising for some people is just how quickly things globally are changing, the rate of that change, particularly given what we're sort of told domestically by our politicians. And any suggestion, as the Prime Minister did make in Canada, that countries are going around dismantling their emissions trading schemes is simply not true. So I think we need to start from the premise that where we are right at this moment, and today we were expecting the carbon price to be repealed. That will probably happen tomorrow. I think there's been a bit of negotiation a couple of hours ago with the Palmer party, so that will probably happen tomorrow, is completely at odds with what's going on elsewhere. So there are three things I really want to talk about today. The first is that there are physical impacts of climate change that we cannot ignore. Secondly, there's a pattern now of global regulation emerging around the world where governments are responding to these physical impacts. And finally, regardless of what these physical impacts are and what policy is going on, the investment community is responding very aggressively to the issue of climate change as well. So the first point is, can I just get the slides up if that's okay? The first point I want to make is that the issue of climate change and climate volatility is something that's been known for some time. This is the cover of Time magazine, which I think is 1994. So it's not a new cover. It's an issue which we're being told about by a well-respected magazine that there is going to be some very significant physical impacts of climate change. And again, this is 10 years old now. We know that climate volatility is a reality, and we've seen that climate change itself can cause some real impacts. And when you look at what happened in Queensland with the floods and with the cyclones, they have significant economic dislocation, and they affect supply chain and the way in which business operates. Many countries are engaged right now in very detailed risk assessments of what impact climate change will have on their economies and their communities. In America, for example, right now, the US government has set up a website where you can go to anywhere in the US and look at what is the impact of climate change on the area in which you live or any other region in America. Florida and New York are engaged in very detailed risk assessment programs to work out how do they manage future climatic events which they've suffered in the last few years, and how do they actually prepare themselves for that. In Australia, we're also highly vulnerable. One of the bodies that I sit on is the New South Wales Climate Change Council, and we had a presentation recently by the head of the New South Wales Fire Service, and he made a point that I think that really sort of resonated with me, which I think is very important. He said that in New South Wales, the fire service fights fires within these ranges of temperatures at around 40, 41 degrees. And last year in the fires in the Blue Mountains, there were a number of fires coming together very quickly, and it was only because of some rain that happened at the very last minute that those fires were able to be managed and put out. There were 2 points he made. The first was that had those fires have come together, it would have been a catastrophic event and like nothing they had ever seen before. But secondly, given the predictions of where temperature's going, up to 42, 43, 45 degrees, they actually don't know how fires combust in those temperatures. So based on what they know to date, the policy is just to get out and run. It's not to try to save homes or protect people. It's to get as many people out as they can and not fight the fire when they don't actually know how it will react. So one of the challenges we have in Australia at the moment is that rather than assessing these types of risk and investing a lot in these areas, we're shutting down the very institutions that do assess this risk, shutting down the CSIRO's climate division. The government wants to get rid of the Climate Change Authority, which it looks like will not happen. But we're in an environment here where there is significant risk and a lot of uncertain risk, and we need to be really managing that risk and working out what that is. So not only have a lot of countries therefore looked at this risk, this brings me to the second point, which is that for those countries that acknowledge there's a serious risk, they're responding to this by implementing significant domestic policy. And one of the things that we that we see here, and I'll just go to the next slide if it's okay. Around the world today, what we're seeing is a significant development of domestic emissions trading schemes and measures to limit the growth of greenhouse gas emissions. Now, historically, since 1992 with Rio and what's happened in 1997 with the Kyoto Protocol, the world began this global regulatory process of dealing with emissions by establishing a global framework to deal with climate change. It set up the Kyoto Protocol, under the United Nations Framework Convention on Climate Change, and that protocol was designed to set caps on countries to reduce their emissions. The problem with the Kyoto Protocol is that it only sets an initial cap from 2008 to 2012. So the big international debate now is where do we go at an international level in terms of regulating global emissions through an international framework. And when you hear people talk about what's going to happen in Paris, they're referring to the climate change negotiations at the end of next year, where there's an expectation now there will be a new global agreement to get countries to agree to cap their emissions at a global level between now and 2020. However, what we've seen while that debate goes on is most countries around the world are no longer waiting for that. They're saying that we believe climate change is such a risk that we need to manage it at a domestic level. We need to put in place domestic measures that regulate greenhouse gas emissions, and we need to do it in a way that is conducive to our own economic circumstances. So the shift has been from this sort of global international approach to a much more bespoke national economic approach to dealing with emissions. And the big question, I think, for the next 5 to 10 years is then when these schemes are up and running, how do they link together? And there's a lot of dialogue around that. So if we just take 3 examples. China. So we often hear that China is one of the key countries which needs to be reducing its emissions and it's polluting very heavily. And until China acts, Australia shouldn't be moving. China now has in place 7 domestic emissions trading schemes at a provincial state level. The smallest of those schemes covers around 200 million people. So when you think of just how significant that is and the fact that they're planning to move to a national emissions trading scheme within a year or two, the developments are moving very quickly. A lot of international, multinational companies are caught by those schemes. They're already regulated and they're already trading carbon. So when you combine that with everything else that China's doing around investing in renewable energy, they are on a path to transform their economy. Bearing in mind they still are heavily polluted and rely on coal, but they are moving in a very different direction. The US, the Obama administration has obviously, since it's been elected, made climate change a key priority. In the first few years, it was very difficult to get any, and it still is, get any legislation through the parliamentary process. And so Obama's now gone outside that process through the EPA to regulate emissions across the country. So the recent announcements by America are a very significant national approach to reduce, to get each state to impose measures on their state economies to reduce emissions, particularly by regulating old coal plants and also through methane capture. But that measure significantly is not in isolation. There's already significant energy efficiency, renewable energy measures in the US, which are creating significant investment. Also in the US, we have the California emissions trading scheme, which is now up and operating. It's linked in with Quebec. It also has other linkages with offsetting programs in Mexico and Latin America. And so the recent American announcement around what the EPA will do simply comes on top of those existing emissions trading schemes, which also includes one on the east coast of the US as well. So again, two of our key major trading partners moving very fast on regulating emissions. And then finally, frontier markets. In a lot of those markets which are more remote than our major trading partners, they're also moving quickly to put in place emissions trading schemes. Uzbekistan and Kazakhstan, which are two very resource-rich countries where Australian companies are looking at investing, are in the process of developing an emissions trading scheme. Countries like Gabon, which is a West African country, has put in place a very sophisticated national sustainability scheme, which includes a trading component. And again, there are a lot of multinational mining companies looking at that country to see what opportunity there is to invest. So around the world, we're seeing this progression of the development of domestic measures to cap the growth in emissions. It will have a cost to business. It does change the merit order of energy. It also imposes a plethora of different compliance obligations across many different jurisdictions, and it also moves us towards this concept of stranded assets, which I'll talk about in a moment. So I think as this goes on, and as we often hear a lot about the impacts of this, I think it's the question often arises, well, what does this mean for the fossil fuel sector? And I don't think there's any suggestion that over the next 10 to 15 years we will stop burning coal or get rid of fossil fuels. The real message for the fossil fuel sector is that things are changing, and that particularly with respect to coal, there's an expectation that it will operate in a carbon-constrained environment that's simply growing every day. The final point I want to talk about then is international capital flows. And there's a lot of discussion around this concept of stranded assets, which you may have heard, where people are arguing that assets are going to be regulated so heavily on their greenhouse gas emissions that they will become stranded and no longer a valuable asset. There's a lot of talk about this concept of the carbon bubble, which is that there's only so much pollution or carbon pollution we can put in the atmosphere, and there's only so much the atmosphere can take, and yet our reserves of coal are far beyond that level at the moment. There's a lot of debate about these concepts and these principles, but when you look at, in the stranded assets sector, where the price of thermal coal has gone and the trend, it's obviously clear that there are trends in that direction. Also, it's interesting that these concepts, which have been pushed very hard, have had quite a significant response from companies like Shell and Exxon, who have not necessarily agreed with the principle, but have said even if it is true, it doesn't apply to us anyway, and we're divesting from certain of those assets. So while these concepts are not necessarily as yet the key trend line, the fact is that there's a basic premise that because of this global regulation of greenhouse gas emissions, certain high-emitting greenhouse assets will become stranded or less attractive, is certainly starting to occur. And the important thing is that it's interesting that in the recent debate in Australia with the Minerals Council and others who have been saying that this concept is really not justifiable and almost saying that it's almost, in fact, the Minerals Council report recently said it's almost illegal for people to be articulating this. I think it misses the point that there seems to be a thesis that it's the green groups who are pushing this concept very hard. But in fact, the main proponents of these principles are investors. So when we talk about this, when we look at recently what happened on Abbott Point, when you look at the Abbott Point facility, which is the coal mine and Barrier Reef, is looking to raise money for an expansion. One of the main proponents on that was Deutsche Bank, and Deutsche Bank were lobbied extremely hard by German residents who believed that it was not in the interests of Deutsche Bank to be investing in a facility in Australia that potentially had a significant ability to cause environmental harm. In the paper today, there was also an article that there was some Queensland tourist operators who were also very active in lobbying Deutsche Bank. But this is a major international bank who has made a decision that this coal asset is not something that they can invest in. And as we see the banks start to be more concerned with reputational risk, more concerned with where they put their money, more concerned with signing on to principles like the global PRI principles, they're being held to account by the very standards to which they now bind themselves. So we've seen similar decisions also in the past in Tasmania with the pulp mill, but the point is that we're seeing this trend now of investors being far more willing to walk away from investments that have a carbon risk and a carbon element. And then finally, the point is with investment flows is that investors ultimately look for money and opportunities, and they'll walk away from where there's risk and they'll go to where there are significant potential growth. So one of those areas at the moment is of course, and Giles has written a lot about this, is in solar. With the massive growth in solar around the world, but particularly in Australia, when we hit the point where batteries are economically viable to support solar, then there will be a significant game changer. And in that case, a lot of people I speak to say that is between 18 months and 8 years away. But even if you pick a middle spot of 4 years, the fact that people can put solar panels on their homes, back it up with batteries and be self-sufficient is something that all around the world is gaining increasingly attraction. Is becoming increasingly attractive. And as a result of that, we're seeing a lot of investment and private equity flow into that space. So in the same way that we have a shift from Kodak to digital, we'll be seeing significant shifts in areas that are focused on reducing emissions, particularly in the energy efficiency and in the renewable energy space. So in conclusion then, I think what I really wanted to say was we sit at a very important point in Australia at the moment where we are possibly tomorrow to be faced with a situation where we have no regulation at all of emissions in the country. This photograph is a photograph of Greg Hunt, Chris Pine and others celebrating when the carbon tax repeal bill was passed through the House of Reps. I think it's an interesting photo because when we look back on this in maybe 10 years' time, well, if Palmer gets his way and next week introduces an emissions trading scheme, then Mr. Hunt in that photograph has already called an emissions trading scheme a carbon tax in drag, was I think the words he used last week. Australian politics is never really going to... the issue of climate change will never be resolved in a political situation until we have a bipartisan approach on climate change. Whether or not Clive Palmer is the game changer by introducing an emissions trading scheme that the other parties agree to remains to be seen, and whether or not the Liberal Party will agree to it at all also remains to be seen. But based on their statements that they will not support an emissions trading scheme, and based on Palmer's position, there's no direct action with no emissions trading scheme, the expectation is that by this time tomorrow we will have no regulation in Australia whatsoever to cap pollution, greenhouse gas emissions from polluters in this country, and will be the only country in the world that has gone backwards and removed that domestic measure. So I think there's a final picture there. And then finally, I just wanted to end on the Al Gore Palmer note. I think that, again, in an Australian political domestic context, people should not underestimate how significant this moment is. There's been a lot of press about Gore and Palmer, but this was not a one-off sort of meeting. This was an orchestrated attempt to convince the party, which had the balance of power in the Senate, in effect, to change their position. And Gore and those who were working with him, including Tony Windsor and others, were successful in moving PUP in a particular direction. Earlier this week, we saw Ricky Muir suddenly come out and be an advocate for ARENA. So Australian politics is moving in very funny ways at the moment, but I think it's very important that as we go forward that we continue to recognise that there are risks with climate. It will have economic impacts, and if we do introduce an emissions trading scheme of 3 or 4 years' time, the task and the emissions reduction task before us will just be a lot greater, and the economic transition to do so will be harder. Thank you.